Hi everyone, I'm Tony Verhoeven, Marketing Manager at CSIA. Thank you for attending this month's CSIA webinar. A reminder that if you have questions for our speaker, please use the Q&A box to the right of your screen, not the chat box. This program, like many of CSIA's webinars, will be archived on controlsys.org, typically within 24 hours of the broadcast. CSIA just launched our own podcast. It's called the Talking Industrial Automation Podcast. It's a show to help you get to know the people that make modern manufacturing and processing possible. Along the way, we will touch on integration technology, trends, and challenges. If you are a manufacturer, end user, client, supplier, or system integrator interested in industrial automation, I hope you will enjoy the insights CSIA members will bring to this podcast. Visit talkingindustrialautomation.com. Many thanks to John Weber, Monica Anderson, and the whole team at Software Toolbox for hosting and sponsoring our monthly webinars. Software Toolbox was created in 1996 to rid the industry of bad third-party software experiences. They do this by providing a variety of industrial automation software tools and applications, the knowledge of how they work together, or with automation software to deliver end-user value, and a responsive, proven support process, all focused on lowering risk. Find them on the web at softwaretoolbox.com. Cathy Durham is a principal of the Capital Valuation Group, where she serves as president. For more than 25 years, she has specialized in assisting the owners of advisors of closely held businesses in the areas of business valuation and litigation support. Cathy has managed, owned, and sold businesses and has served as a director of a number of businesses and nonprofit entities. She co-authored the firm's publication titled An Introduction to Business Valuation, has authored numerous articles for business publications, and has been a presenter at national conferences throughout the United States. In fact, Cathy will be a presenter at the Executive Conference in San Francisco, April 24th through the 27th. Cathy has also earned the American Society of Appraisers Accredited Senior Analyst designation and is an active member of the Financial Consulting Group, North America's largest organization of independently owned business valuation, litigation support, and financial consulting firms. Please welcome Cathy Durham.
Good morning, all who are joining. As you can see from the title here, no one is getting out of here alive because, well, I guess that's kind of a blunt introduction to this topic, but maybe one that's needed because it does seem that many business owners forget that the statistics are pretty strong, that 100% of us are going to pass on at some time, and so our businesses and our employees will be left behind, hopefully, though, to continue. And so I'm here today to say no matter your age, it doesn't matter if you're close to retirement age or not, that to think of your business as both your employment and an investment, because that investment is no different than the stock market or real estate or other things that you may have invested in, other assets you've invested in. You need to think about when to get in and when to get out. So that's our topic today, and I hope I'll provide some interesting kind of updated statistics. If we go to the next slide here, let me see if I can do the process. I'm sorry, I'm aiming for a little arrow here. All right, so today's agenda is to give you some interesting information about what I'll call the pig in the python event that we are living in our society literally as we speak, and then talk about some key topics in just transitioning ownership. We're not talking about employment, we're talking about your business as an investment, who might be the potential buyers, and how do you decide when is the right time. And then finally, I found it incredibly interesting, or at least it was for me, and I hope it is for you, a PricewaterhouseCoopers survey of about 250 business owners where they identified 8 challenges that business owners are experiencing, and so I hope to share them with you today so that you can avoid them. So let's get started. So I put up this slide here. This was actually the front cover of the Post magazine back in November of 1946. So Dad is looking in the window at the baby, and the men are back, and the boom is on. And I put this up to just articulate or to show a kind of an interesting example that anybody born between 1946 and 1964 qualifies as a baby boomer, myself included. And we are quite the pig in the python, as you've probably heard more in the healthcare world than anything, because we are aging. And so today, those boomers are ages 54 to 72. And what's fascinating is that back when the boomers began to turn 65, which was 2011, everybody was geared up that there is going to be this tsunami wave of businesses beginning to change hands because the baby boomers are turning 65. And by the way, they are turning that at the rate of 10,000 a day, and that will continue for that period of time, about 18 years. So it is a large group of people who, by the way, are also very entrepreneurial, as you probably are joining us here today, a business owner. I'm a business owner. We have 70% of all businesses in our country right now owned by boomers. So it is a significant shift that is going to occur, and why we did not see that happening at age 65. In fact, we're just beginning now as a valuation firm to see business owners calling to say, I got to figure out what to do with this ownership interest of mine. And so they're 72 years old, so they are much older than 65. So we can talk in a minute about why that is as well, because it is interesting to kind of know what's going on in your demographic. So whether you're a boomer or a Gen X or a millennial doesn't frankly matter. You own an investment, and thinking about that and thinking about the right time to transition in or out of ownership is the key. So as I said, there are a lot of baby boomers, in fact 75 million of us, which is greater at this point in time than 1/4 of our total population. And as I said, we're between the ages of 54 and 72, and indeed, because of that and because of the high level of ownership, it will be the largest intergenerational transfer of ownership interests in business in the history of the world, not just the United States, the world. So if we just focus on the business side of it, there are 27 million closely held or privately owned businesses in our country today in the United States. If you talk about publicly traded companies, there are 16,000 of them approximately. So clearly the drivers of our economy are the closely held or the privately owned business. But what I like to focus on is the next statistic, which is, all right, of those 27 million, how many of them actually have employees? So they're not solo practitioners. They are not mom and pop shops where it's husband and wife or family members. It's really that they have employees and are generating revenues, et cetera. And that 70% of those companies are owned by boomers, and they will transfer either by plan or by being carried out feet first. That ownership interest will change. So the importance of thinking about your company as a transferable legacy, something you've created. You want your employees to stay employed. You want your family to get the benefits of what it is you've been building. So that's really our focus today. Because if we look at the typical portfolio of a business owner versus an employee or somebody who has a pension, et cetera, you could change this and say, what is the asset allocation for the typical 72-year-old as well? And on the right is where we really want to be to reduce our risk. And by the time we are even close to retirement, that's the goal, is to get our portfolio looking like it's a good mix of stocks, bonds, cash, et cetera. On the left is what the portfolio looks like for most of us if we own a business. And that is, we have some investments in other types of assets, but primarily our wealth and our retirement is invested in that business. So we are indeed asset rich but cash poor, and the idea would be to get towards a more liquid situation. I do think that the reason why so many business owners do not, I think first of all, we think about the age 65 as time for retirement. That really came from a generation ago when there were pensions, and everyone had a pension, and the pension dictated 65 as retirement, as does Social Security, et cetera. But for the business owner, what I'm seeing is we're much healthier as a generation. We really like control, and we like going to work. And so the idea of selling or preparing for that is not it's not getting our attention. Therefore, I'm naming seminars such as No One's Getting Out of Here Alive so that I can get your attention. All right, so this is kind of an interesting chart because what it can tell you is the reason why those statistics are important to you or should be important to you is that there is going to be a significant increase, as you can see here on the red line in the middle, of when are baby boomers going to be putting their businesses up for sale. Now, if we'd looked at this 5 years ago, the peak would have been about 5 years earlier. So it's an estimate, clearly, but it's really saying that by 2022 to 2025 is really when the majority of the businesses for sale will peak, and that more importantly, that after that point in time, my concern is who will be the buyers. Because if we've got 70% of all businesses coming to the marketplace, peaking in 2022, let's say, then the buyers are going to be pretty much used up or consumed, depending upon the industry, by that time. And then the buyers are either going to be private equity or investment bankers, which frankly don't align very well with the closely held businesses philosophy. That we, at least the business owners that we're working with, the majority of them would accept lower price or value for their business if it means that the business will stay local, that the employees will truly keep their jobs, not just lip service that they'll keep them, but they keep their jobs. And so that's kind of the opposite of the philosophy of private equity and investment banks, which is to buy and to make more profitable either by squeezing expenses or by putting better management in place and then flipping it or selling it again within a 3 to 5 year period of time. So who do you want to have as your buyer is the other side of it. And I think that this tells us when we need to be thinking about, we don't want to be at the top of that curve. We want to be before that curve, actually. So why is it difficult for business owners to think about transitioning their ownership? And where I find almost magic is that when I'm teaching to business owners or talking with them, what I realize is that they forget that we wear two hats. We are both an employee of our business, right? You could go down the street, work for a competitor, and you could get paid market levels of compensation, and you could go to bed at night and actually go to sleep. Unlike those of us who have decided to be entrepreneurial, we also own our business. It is an investment, and it keeps us awake at night because we're worried about the future of it. Where does the next sale come from? What about my employees, et cetera? So what we're talking about today is not about quitting working, because as soon as I show and kind of, it isn't like we don't really know it, I just don't think we think about it that way, that we wear two hats and that you can continue your employment, you can protect your compensation, you can protect your schedule, you can contractually define what relationship do you want to continue to have as you either slow down or continue to hit it hard and go to work full-time plus. But the employee piece of it is very negotiable by contract. The ownership side of it is what I'm talking about. Get out of the ownership piece of it. Still go to work, but really think about transitioning that ownership. And so the next piece that we need to look at then is, all right, I'm going to think about selling my business. Where do I begin? Well, I would think that one of the key places to begin would be to identify who are the potential buyers. Now, this chart looks quite busy, and it's frankly something that you can be looking at on your own later on. But the key here is that we put this chart together several years ago, really as a teaching tool, to show that there are different groups of buyer types, and that some buyers are willing to pay less than others. And so if you look at the bottom groups, that's who pays the least for a business interest. And as you move up the chart, that at the top, the strategic positioned business is the one that would pay the highest value for a business. And I think for you looking at it, as we talk through it, it's important to think about who in your world fits these different buyer groups. So the 1, 2, and 3 down below are passive, undiversified or diversified investors in your business. So this is like you investing in the stock market. You don't work in the business, you don't understand the business, you're investing your dollar in it because you believe you can get a better return on your investment. It would be somebody like me coming to meet with you and saying, I'm interested in buying your business. So I have a lot of risk because I don't understand the industry or the business. I'm a passive investor. Higher risk is lower value. So that the lower buyer groups really are only of interest. Typically owners of businesses don't set out to sell to passive groups. And in fact, that private equity buyer is one of these. The investment banking buyer is one of these, unless they're specializing in going after businesses in a particular industry and kind of aggregating them. So these buyers in the first, second, and third sections are really the buyers who are, we are instructed when we're valuing a business because of someone's divorce, or we're valuing a business because of somebody's estate taxes, this is who we are instructed by the IRS to characterize the buyer as. So for those purposes, we come in with a low value. So it is not something for retirement and thinking about selling to a best fit buyer or a buyer who would pay a higher value. So the next three, numbers 4, 5, and 6, could also be aggregated because they represent who is working inside your business. This, frankly, is who typically buys closely held businesses. It's an employee, or it's a group of key employees, or it's where it's actually organized as an ESOP or an employee stock ownership plan. So these are the buyers who do understand the business. They do have some of the key relationships in the business. They know who they buy from and sell to. They have ideas about ways to improve the business or to do things differently. So they have less risk and are willing to pay a higher value. Then as you move up that chart, and by the way, back on 4, 5, and 6, that it's the employee groups, that's what I'll be speaking on at the conference in San Francisco this year, is a case study of an insider group buying a business. And it is a system integrator business. And so looking at how does that deal get done and what are the issues revolving around that and some of the important mistakes to not make in doing that transition. So if we move up to number 7, everybody thinks about number 7. I'll sell my business to my competitor, because your competitor is typically in either a contiguous geographic space to you, or they're right there selling to the pet food industry or the healthcare industry. Maybe they have the same sector that they're selling into. But a competing business would absolutely pay a higher value because they immediately would get your market share. They can usually get rid of duplicative expenses, like you don't need 2 marketing teams, you don't need 2 accountants, you don't need usually sometimes even 2 sales teams. So it's really a place where both cash flows can be increased, as well as the fact that there is less risk because they certainly understand the business, so value again is higher. What we think less about would be the next one, number 8, diversifying businesses. This is when there's vertical integration going on, and it's really saying stop and think about who do you buy from, who are your vendors, And who do you sell to? And would one of them be interested in growing vertically by buying your company and kind of getting that profit margin or that profit center included in their own vertical growth? So that's one to think about, I think, and one to also, when you're going to the conferences, to stay in front of all of those people in your industry, tell them or speak about successes you've had in your particular business. Because I may be in Michigan, and I'm thinking that I would like to buy somebody's firm in Iowa or Indiana or somewhere close. And how will they know about you other than having contacted you or listened to you speak or write in the publications of the industry or speaking at the conferences on successes that you've had, where they recognize that you do what you do very well and that you would be an attractive target for them. Then moving up to number 9, the strategically positioned business. This is when consolidation is going on in your industry. So the only way you can tell if consolidation is going on is typically from your associations, CSIA, as well as control engineering and the publications that are keeping you abreast of not only the technical happenings in your industry, but also are the larger companies buying up smaller companies, or are even similar sized companies buying each other to have a larger footprint? Because when there is consolidation going on, that's when companies will pay higher, we call them crazy values or crazy prices, because value is one thing to them. Price is even higher than value because they want to get the best ones, or they want to get the ones that fit their business plan best. So this chart is put up really so that you think about the fact that your business has many values depending upon who the buyer is. And for you to identify who your buyer might be would be a great first step in thinking about transitioning ownership. Because we're not talking about, with ownership transition, we're not talking about something you're going to decide to do today and by June you'll have it done. It is typically a 2 to 5 year time frame of starting the dialogue of thinking about selling your business to the point when you can, as I say, lay on the beach with an umbrella drink with your asset turned into cash so that you can golf or vacation or do as you wish for your retirement. So then we move into when is a good time to think about selling your business. Well, we can help on that left side. The value that's sitting on this fulcrum, that pyramid, represents having somebody come in and looking at your future cash flows and your risks and opportunities, as well as the intangible items of value, such as your brand and your reputation and your employees and your processes in place, etc. And we arrive at what is the value of your business. But when you leave our offices or any appraisal office, they should tell you, if you go to the marketplace right now, you will not get this value. You will get a price that is either higher or lower, because in any actual transaction, you are negotiating for who has the advantage. So if I'm really interested in your business and I'm motivated to buy your business, I'm paying attention, I'm thinking it's a great fit with my business, I come to you interested in buying your business, and you say to me, you know something, the economy's going well, we're having a great time, I'm really not interested in selling right now, but you know, I'll keep you in mind. Well, I as the buyer then am motivated to increase my price until I can get you to sell. And so you not being in a hurry, you being organized and being ready to sell your business makes it that you are in a position of advantage and can get a price that is higher than the value of your business. Now, the reverse of that, the fulcrum can go the other way, unfortunately, as well. And that's more when maybe after I've been calling you for the last year telling you I'm interested and you keep telling me no you're not, then you wake up one day and you realize, you know something, I'm really tired of fighting the fight, whether it's employees, whether it's your customers, burnout, or unfortunately if you're diagnosed with something terrible that means, you know something, I have got to sell this business quickly. That will be figured out by the buyer as you go through the due diligence of selling your business, and the position will change and the fulcrum will go the other way, and the price that you will get will be lower than the value. So the key here is no different than if you're an investor in the stock market, where the advice, of course, sounds very simple. You want to buy low and you want to sell high. Similarly, in a closely held business, you want to think about selling your business when things are good, when you're actually having fun, which seems to be what's going on right now with the economy being strong. When most people think about selling their business is when something like the Great Recession that we've just recovered from, when you're going through that, you would do anything to get out from underneath the ownership of that business. But unfortunately, the market is not favorable at that time for doing it. So it's really thinking about when is the right time for you personally, setting that timeline, and then beginning to move towards that process of, again, keep working if you would like to, but think about getting out from the ownership. Because here are the factors that we don't control, those things that are outside of your control, like that recession that we just talked about. That's not the time to be selling a business. The time to be selling a business is after you've got a nice trajectory of 3 to 5 years of business is growing, revenues are increasing, profitability is either holding steady or increasing, hopefully. The competition can change very rapidly. And I think one of the things in your industry or in my industry or frankly any service industry that we have to be very, very aware of is that the internet is becoming a disruptor to many, many industries. And I don't think that we are protected from that in our service businesses, because I've read and heard and been at conferences where where the discussion is really, you know something, it won't be very long before we don't need architects, engineers, valuation people, accountants, because the algorithms will be built such that people can go out and get it for themselves. Now, to some extent, I'm a believer in that, and to some extent, I am not, because I hope that human relationships will always matter, but be sure that you're looking over your shoulder, not just at your competitor who's in the next geographic territory, but also paying attention to how the internet could come in and take over parts of your business. You know, and you, I think, in this industry have the great opportunity to be able to customize so much of what you're doing that still matters, but algorithms can be built, and I've argued for years that, you know, valuation is something that can't be done just by algorithms, but as things become more sophisticated, and it's moving, frankly, more quickly than we thought. So paying attention to the internet. And then that your product or your service may become less desirable in the future. You know, it doesn't take much for us to look out at what happened to Kodak or what happened in the music industry or the home video industry. You know, I sit on a bank board where just yesterday we were talking about how easy it is for various mortgages or loans or, you know, the typical things that you or I might walk into a bricks and mortar bank to get done. The next generation just uses that great rectangle of knowledge, that telephone, and that's where they want to sign up for their loans and sign up for things that banks traditionally do. So in the banking world, the internet is having a big impact, and it will in other industries as well. So keeping track of that and thinking about it so you don't get surprised by those economic factors. We also have that issue of health concerns that none of us know really what's going to happen to our health, and you don't want to be in a position of your health forcing you to sell. Because ultimately the buyers will learn of what's going on, and that fulcrum that we talked about will change. Similarly, many times in a service business like yours or mine, the seller is interested in you staying on. Even if you're selling to your employees, there's typically 1 to 3 years that they want you to stay active so that they can get help with transitioning key relationships as well as what it is you have in your head from all the years of experience that you have. Similarly, what a shame to work as hard as we've worked for our careers and miss out on those best years of being able to play because you held on to that business and it consumed your time and your energy for too long. So, right there. Now, you know something, if there are any questions as we go, I should have said this at the beginning, just send them my way. It's almost easier to answer the questions when you're on topic as it is at the end, but happy to answer any and all questions that you're thinking about. So let's move over now to that PricewaterhouseCoopers survey of business owners that they did, because the whole question was about what's going on with transitioning ownership and where are we and what seems to be the problem. And the first one that they identified out of the 8 challenges is that there's minimal mind share, which is what we're talking about today, that a very few business owners have given any attention to their transition plan. So they've not even thought about it. It isn't, and they can be 72 years old and haven't thought about it, or 68 or 48. No matter your age, transitioning is important. That 88% of them have no written business plan, while 66% of them had no plan at all. So forget about even putting it in writing. The third challenge that they've identified is this area of going it alone. And here, I think that I know there are great resources available, many of them for free initially, for you to reach out and to say, all right, now here it says 80% of business owners had never sought advice about a transition. Now, if they haven't sought advice, I would think that's because of 2 things. They don't want to spend the money on it, and they're busy putting out today's fires, running the business. They just aren't taking the time to do it. So the time part of it is clearly something that you're going to have to be disciplined to be able to figure out. But the piece of it of going out and paying for it, did you know that you could reach out to any estate planning attorney and they will meet with you for an hour and you will get very good information about how do I begin this process? Here's my particular situation. Where do I begin? Similarly, accountants will do that. Valuation people will do that. And if you happen to live in a university town or environment, there are typically family business centers or outreach programs that you can attend or reach out to. Even people, like in our area, we've got this thing called SCORE that is also organized, I believe, through a combination of our university, that really are retired business owners. And so they can be very, very valuable for getting information. So it doesn't mean sign up for spending money right out of the gates. You can begin to gather important information about where to begin. I think the 2 pieces that are needed if you're thinking about transitioning out of the business, one is, what is the value of my business, right? And the other side of it is, how much money am I going to need when I do retire? And so that's what I think points 3, 4, and the next one get after, really, is that you need to be able to understand first what is your requirement, and that's really financial investment advisors who can be very, very helpful in helping you to understand, all right, well, how would you see your lifestyle changing after retirement or after ownership, and how much money do you need, estimating your age, et cetera. Very important to have that side of the equation. Then you go over to the other side of it, which is, what is the value of my company? And obviously, that's what I do, but I'm not here selling my services. I'm here to say that, unfortunately, what I see too often is that a business owner will start doing number 4. They'll meet with their financial investor, and they're told that for their way of living and what they would like to do for travel, et cetera, that they need to have, let's make up a number, $3 million in accounts where before they can retire. And then they turn around and they try to sell their business for $3 million. And unfortunately, that is not how a company is valued. And even though you know your sweat equity has been in that business, it does ultimately boil down to cash flow, risk and opportunity, and a number of qualitative factors like your quality of your employees, whether you have customer concentrations or not, whether you, where are you located, what is your competitive environment. So it isn't just about your financial statements, it's about some other factors, but it certainly is not driven, value is not driven by your financial advisor telling you how much money you'll need. And while that sounds surprising, you'd be amazed at the number of people who start at the starting gate thinking that that's how they'll value or price their business. All right, so moving on to the next slide, that there is this issue of value. And frankly, many times when we finish valuing a business, before we disclose what we've arrived at as our value conclusion, we ask the owner to tell us what they believe their business is worth. And unfortunately, it is most often that the business is worth less than what the owner thinks it is worth. So if you don't understand the value of your company today, you're losing the opportunity to increase value in your business, because you absolutely can learn about or understand the drivers of value in your company, and you can increase value in your company, but it takes time. So you can't wait until you're burnt out or diagnosed with something bad in order to be able to increase value. So if two-thirds of the, let's see, two-thirds agreed that getting full value for their business is important to funding their retirement, that is their top goal in these businesses that they surveyed, yet only 35% had had a valuation done in the 3-year period of time. And I think there, again, you know, it has to do with cost, it has to do with time, but at the same time, would you go, it's the equivalent of saying that you would go with your 401k or an IRA and never look at a statement of value for 20 or 30 years, because that's what happens when we own the investment of our business, but we don't take the time to say, A, what is the value of my company, and B, is it increasing over time? So again, that sounds like I'm selling my own services. You can go and talk to any appraiser you care for, not me necessarily. It's about getting an appraisal done so you have a stake in the ground to understand it. The sixth challenge is this idea of many business owners, as we meet with them, are doing what we'll call tax planning. They are trying to reduce the taxes that they have to pay this year by any number of things that they're doing, whether they are using the depreciation for increasing depreciation rapidly under Section 179. Some of them might be running individual or personal or discretionary expenses through the business, or they'll prepay expenses at the end of the year so that they can at least bump out some of those profits to a future period of time. So that tax planning is an interesting thing, because we all are conscious of the fact that at the end of the year, whatever profits we have to pay tax on. And there are those business owners who are interested in trying to reduce that. Well, when it comes time to selling your business, it is really important to not do that, to stop doing that for at least a period of 3 years, because you're not likely to find a buyer who's intelligent, who is willing to say, oh, all right, well, tell me all the things that you've done with your accounting, and we'll just adjust for those. They are going to look at your tax returns and your financial statements and rely on that information in order to arrive at a conclusion of what they're willing to pay for the business. Plus, if you've told me that you're, we'll just say politely, kind of moving or maneuvering the amount that you're going to pay in tax, that also makes me nervous about the quality of your financial statements in general, including the fact of running discretionary expenses through a business. So I think that business owners start a business And whether they pay for their kids' education or their wife's or husband's car or the gasoline or cell phones or the landscaping gets done at the office and also gets done at home and the business just pays for it, it feels like it's all one and the same. Very important when you're getting your business ready for sale that you separate the operating business from your personal life. So if that means you've got a boat on your balance sheet that isn't really needed for business operations, good idea to get it off your balance sheet. If you're running those discretionary expenses through your accounting, get those out of the accounting for that 3-year period of time. And I actually did an analysis of looking at how much money would you have left in your pocket if you did your tax planning, and what money did you save for that 3-year period of time because you did tax planning, versus if you stop doing that tax planning and you instead get the increased profits, you pay the taxes on those profits, but then those profits are included in the valuation, you will come out farther ahead by a significant number by reporting things as accrual accounting. Report your revenues and your expenses, only business expenses, as they're happening. And you will come out much further ahead in value because value is multiplicative of the cash flows. So just a heads up, and again, one of those things that takes time if you're doing those things to change them. The 7th item that they found, and again, this one is of particular interest to anybody, even if you're not even close to thinking about selling your equity interest. If you do not own 100% of your company, there are other owners in your company, it is extremely important to have a buy-sell agreement in place that is, and maybe it's called a shareholder agreement or an operating agreement, but it's an agreement that says, here's how we will act when one of us gets out of this business ownership. And that may happen via death or disability, and that's the shortcoming that we see in those who do have buy-sell agreements, that when we turn to the pages that talk about the valuation provisions, how will this company be valued under these circumstances, that's where there's lack of clarity, lack of detail, and it is a field mine for argument, and we've seen litigation that's gone all the way to the Supreme Court with people who started out in business being very excited and hopeful and wanting to work together, but things happen and things change. And so the key is that every buy-sell agreement should have valuation provisions, in other words, text in there that will say, if this event happens, there are 5 of them, 5 events that could happen that we've identified anyway, that need to be spoken to. Death and disability are only 2 of them, and they're the easiest because you can insure for them. But it's language that covers such things as if somebody dies, we will value 100% of the business, and let's say they own a 48% interest in the business. That's a minority interest. Will there be a discount for minority? Will there be a discount for lack of marketability, as there is in every closely held business valuation? And are there any other discounts or premiums that you'd like to have apply? In our firm, we've looked at it that if somebody dies, they don't do so by choice. We can insure it. So we pay out 100, we value 100% of the company, and it's just pro rata. There are no discounts other than the discount for lack of marketability, and then it's a pro rata share that gets paid to the estate. Same thing with disability. We can insure it. What if somebody quits? Your business is like my business. Our people are really important to us, and we take on other owners to have a security, kind of a safety net, that we're committed to this. We're not just going to go find another job today because a project has gone badly. We're going to be committed to each other. So in our firm, if you quit, you not only have the discounts for control and marketability, but there's also another haircut of 25% that's taken right off that 100% value because you're leaving us holding the bag. So we can motivate behavior in our buy-sell agreement by having it be that there are additional discounts like that. The other two areas would be retirement. I don't think that you want to pinch somebody for retiring. Hopefully they've not surprised you with it. It's been discussed and planned for. So in our firm, that means if you own a minority interest, there is a discount for lack of control, and there is a discount for lack of marketability. But that's it, because that's how an outside buyer looking in at that equity interest would treat it. And then the last one would be, what if they're fired? And while you may not, that idea that one of you might be fired seems like an extraordinary event that would never happen. Trust me, it happens. And so speak to it when you don't know which of you will be the triggering event person, which of you will be the first one out. The time to define how you want to treat this is before you know that. That's how you can describe fair for your group. And when I'm talking with attorneys about this, they'll say, well, Cathy, give me the boilerplate, the template to put into these agreements. Well, there is no boilerplate because it matters. It's about you as owners sitting down and discussing how do you want it to play out. So I can give you the questions that you should answer, but that language has to reflect your intent, and your intent is unique. It might be different than somebody else. And then the last challenge to avoid is this idea of thinking about your management structure, that so many times we think about our employees but we don't really think about, have we done a good job of delegating? If you want to increase value in your business, make your business not dependent on you, which means focus on your employees and management succession. So what are the ages of your leaders in your company? And when you look at this, the last statistic there, that only 25% of owners have thought about their managers taking over. Can they take over successfully once they step aside? So ultimately, get to the place where potentially you could leave your business for 1 month and call in to wish happy birthday, but not solve any problems, not get a job that needs to be gotten for the firm, that you have delegated to others, you have documented your processes, you've made it that managers are able to take the business and run with it without you. Doesn't mean you don't still bring value, and it doesn't mean that you can't keep working, but that they could work without you. So think about your management succession and who are in those key roles and what's their succession plan with the business. So that is today's discussion about nobody's getting out of here alive, and I do hope that you heard something in here that's useful for you to think about. And I plan to see you in San Francisco, I hope, where we're going to take a case study of a system integrator. It's an event that actually happened, selling to a group of key employees, and some of the things that we want to avoid or make sure happen. So we'll learn about how do those deals take place and what mistakes to avoid. All right, so is this a question or a comment, Tony, that we see up here?
Let me just grab this real here.
All right. All right, okay. So
in addition to obtaining a company valuation, how would the expertise of a lawyer or insurance specialist fit into formulation of a formal buy-sell agreement?
So the lawyer clearly is there to make sure that both seller, obviously buyer and seller should each have their own counsel. As seller, they are there to make sure that you contractually are protected. That, for instance, most businesses sell in that the seller needs to carry some of the financing. Not all of it. Banks will finance some of the transaction, and hopefully your buyers can be paying cash up front. The beautiful thing is to get 100% up front, but typically there is some paper that has to be carried, and so you want to make sure you have a contract there that is protected and has collateral. An insurance specialist, it's the same thing. You're changing your role if you're no longer an owner of the business. So while you are going to be canceling some of your insurance, you want to make sure that you have things like life insurance on the people who are buying you out. You want to make sure that you have your property, et cetera, the collateral insured in case there's an event that puts those at risk. So the typical team, you know, usually involves valuation person, attorney, an accountant to talk with you and to help you model what is the after-tax cash that you'll have, because that is really a big mistake, is to say I'm going to sell my business for $2 million, and so great, and then the deal is happening and they realize that they're going to have to pay 40% tax on that. Hopefully now that's lower with the new tax law, but that accountant helping you to look at the tax ramifications is important, and insurance, because of needing to have that insurance both before and after. Good question. Any other questions or thoughts? Hoping this was helpful to you today. Here we go.
Here we go, yeah.
Oh, this is my favorite question. What is the EBITDA multiple for the market that you could expect for system integrators selling to strategic buyers? Well, unfortunately, this is where Cathy Durham has to do her multiples of EBITDA are not a meaningful way to value any business. It is EBITDA, earnings before interest and tax, depreciation and amortization, is looked at, and it's okay to look at it this way, as cash flow. That if my business has EBITDA of $300,000, what is the multiple that I can apply to that? That whole concept comes from the publicly traded marketplace, where publicly traded companies are very large, their information is publicly shared, and industry best practices are copied. In a closely held business world, and I can tell you because I've climbed inside of a number of system integrator businesses, one system integrator is very different from another system integrator because you have different employee and employee turnovers. You have different competitive environments. You're selling to different sectors. You financed your company differently. You have more or less debt. All of those factors have to be considered. EBITDA is one number on your income statement. It tells you nothing about reinvestment in capital expenditures. It tells you nothing about cash flows needed for working capital. So unfortunately, while you were probably asking that question saying, I hope she just gives us that multiple, multiples truly are meaningless for closely held businesses, short of if you had an actual valuation done of your business with its risks and opportunities, you could take that conclusion of value and say, what is that as a multiple of my EBITDA? That would be an interesting number and a meaningful number. So non-answer, but maybe the best advice you'll ever get is that there is no such thing as a multiple of EBITDA for your industry or any other industry that is meaningful. It certainly is a calculation you can get an answer, but the answer doesn't mean very much. Any other questions or thoughts? All right, looks like we've got people walking out of their room to go get some coffee or maybe a glass of wine, realizing nobody's getting out of here alive, Tony.
Good. Well, thanks, Cathy. I look forward to seeing you again in San Francisco. If the attendees here are planning on going to San Francisco, of course, you will be speaking at the conference as well. Maybe just cover in a minute or so, what is your topic there?
And the topic there is this idea of if control system integrators, from the majority that we're working with, they're selling to their insiders, they're selling to their employees. So this seminar is going to be around a case study of how that happens and how long does that take and what can go right, what can go wrong, what things to be careful of. So it's really about, and also ESOPs. We'll touch on what are ESOPs, why are they beneficial, and boy, if an ESOP, an employee stock ownership plan, if that fits for your firm, they are wonderful. There are a lot of benefits of them. So either we haven't figured out yet, I might have somebody who's actually there with me who knows even more about ESOPs than I do, because I know just enough to be dangerous. So we will cover that topic, though, because it's a great option if it fits.
Excellent. By the way, to you listening out there, if you're not aware of it, there is an association, a nonprofit for ESOP organizations. So companies that are employee-owned have a resource. So just, it might be esopassociation.org or something like that. But go ahead and Google that if you're interested in learning more about becoming an ESOP at some point, or educating yourself about that. So, Cathy, I think that's the end of our questions. Thank you so much for joining us.
Thank you for your time, and thank you for the attendees for your time this morning. Hope you have a great day.
Thank you, everyone, for your participation in today's program. Note that the full webinar will be archived on controlsys.org webinar archives within the next day or so. Also, many thanks to our host and sponsor, Software Toolbox. Find them on the web at softwaretoolbox.com. If you have not done so already, I encourage you to register for the 2018 CSIA Executive Conference held April 24th through the 27th in San Francisco. If you are contemplating CSIA certification, I highly recommend that you sign up for the Best Practices Workshop taking place just prior to the conference on Monday and Tuesday, April 22nd through the 23rd. Tom Salda and Gordon Cox will be part of the instructor team delivering this workshop. Visit CSIAExecutiveConference.org to register. This is Tony Verhoeven at CSIA. Thanks for attending. Goodbye.